80% of retail traders lose money not because they're stupid, but because they don't have a system. Now I'm going to give you 2 free indicators on TradingView with clear entry rules. No more "I think so," just signal, stop, take profit. Let's go. Open up TradingView on BTC USDT 1-hour chart. Works on everything: stocks, forex, indices, or crypto. Key is liquidity and spreads under 2 to 3 pips on forex or 0.1% for crypto. Remove all indicators from the chart. Leave only clean canvas. Why clean? Because extra lines are just a distraction. We're building a system from scratch without any. Let's get back to TradingView. Click on indicators. The first search is Z-score topability. The author is Stiver Stibbs. Add it. Go straight to the settings of this indicator. On the Style tab, uncheck labels and tables. They just clutter up the screen. Leave everything else as default. This indicator will show red bars at the top and bottom, and between them, green and red oscillator zones. Now for the second indicator, QQE signals. The author is Colin Lack. Its settings are critically important. The default ones won't work. Go to the settings. The Inputs tab. Change the RSI length to 60, RSI smoothing to 40, and leave everything else as is. Why exactly like this? These settings are sensitive enough for the 1-hour chart, but not overly so. If you start experimenting with other values, the system might break, so it's better not to touch them. A simple explanation of how this works. First, Z-score probability uses the statistical concept of the Z-score. It's essentially the 2 sigma rule. Simply put, think of price like a rubber band. If you stretch it too far up, it'll snap back. If you pull it too far down, it'll come back too. The red bands are the boundaries of the normal range. When the green oscillator goes above the upper red band, the market is overbought. Statistically, this only happens about 5% of the time, so a downward correction is almost certain. And when the red oscillator drops below the lower red boundary, the market is oversold. Expect a bounce upward. But this indicator alone gives a lot of false signals during sideways markets. For example, the price might be overbought but keep rising for another 10 candles, or oversold conditions can last for several days. That's why we need a second indicator, QQE signals. It works as a smoothing filter, similar to a moving average, but it's adaptive. It shows the actual trend direction, trying to ignore random spikes. It prints long and short labels only when the movement is strong enough and confirmed. Combining these 2 indicators is like having 2 locks on a door. We only enter when both are unlocked. 3 ironclad trading leads. Listen carefully. Rule number 1, wait for the breakout. Look at the Z-score probability. The oscillator should go above the upper red band for a sell or below the lower red band for a buy. Breakout distance doesn't matter as long as the crossover happened. It could be 1 pixel or half the screen. Either one works. Rule number 2, wait for the return. After the green zone goes beyond the band, we wait until the Z-score probability comes back inside the red bands. In other words, the market is no longer in an extreme state. The extreme point is passed. Next, we need QQE signals to print a long or short label in the corresponding direction within no more than 20 candles after the candle where the Z-score returned to its range. But never enter on an open candle. That's the rule. Why? Because many indicators can repaint within a candle. Only when the candle is closed do we have a fixed value. When all the conditions are met and the label is set, the signal's confirmed. Rule 3, entry, stop, take profit. We enter immediately after the close of the candle where both conditions matched. We set the stop loss beyond the nearest local extreme point. For a sell, the stop goes above the nearest significant high. For a buy, the stop goes below the nearest significant low. How do you determine if it's significant? Look at the chart and find a peak or a dip from which the price has bounced at least once. Don't set your stop behind a random candle with a long wick if it's the only one. It's better to set it a bit wider but above a real level. If you're unsure, use the high from the last 10 to 15 candles. That's safer. Take profit is fixed at 2 to 1. This means your potential profit is twice the size of your stop loss. If your stop is 20 pips, your take is 40. If your stop is $50, your take is 100. Why exactly 2 to 1? Because even if you only have 50% winning trades, you'll still be in profit. And with our settings, the win rate is even higher. Also, don't try to increase the take profit to 3 to 1. That'll lower your win rate because the price often doesn't reach those distant targets. 2 to 1 is the sweet spot. One important note, while the trade is open, you might see opposite signals appear on the chart. Ignore them. Don't reverse your position or exit early. The one trade rule, until your stop or take profit is hit, don't change anything. Emotions are the enemy of profit. If you start second guessing yourself, your system will turn an example of a sell trade. Here's a section on the Bitcoin hourly chart. The price is moving up aggressively. In just a few candles, it rises by more than 4%. The Z-score probability shoots above the upper red band. The market is overheated. We wait for a pullback. What do we say? The Z-score returns inside the bands. Good, the extreme is behind us. Bit later, QQE signals prints us out. Everything was, we enter a short position. We set the stop above the nearest high. It's 9 candles to the left, 2% above the entry point. Take profit is set at 2 to 1, meaning 4% from the entry. Let's look at the result. Price drops, hits the take profit, profit made. Third example, a false signal that we skipped. You see, here the Z-score shot up, then came back down, but QQ didn't print a short within 20 candles because the filter considered the move not strong enough. The price went up again after that, and only then did it fall. If we had entered on the first pullback, we would have hit the stop loss. The filter saved us. Here you can see how important the second confirmation is. I've noticed the general pattern. We don't catch the bottom, and we don't sell at the peak. We skip the first wild impulse and enter on the pullback with confirmation. This slightly reduces the potential profit per trade, but it sharply increases the win rate. It's a trade-off between profitability and reliability. The core of the strategy is based on the principle of mean reversion. It's a statistical phenomenon. Any deviations from the mean tend to return back. In financial markets, this effect is especially strong on timeframes from 15 minutes to 4 hours. Studies show that in 70% of cases, after a strong deviation, 2 or more standard deviations, the price returns to it within the next 12 to 24 candles. Z-score probability measures this deviation in sigmas, while QQ signals filters out cases when the market is in a strong trend and the return does not occur. Another important point is that we use a fixed risk of 2 to 1. This is not by accident. According to capital management theory, with a win rate above 50% and a risk/reward ratio of 1 to 2, you get a positive expected value. The formula is simple. Win rate times profit minus loss rate times loss. Using averages, 0.6 times 2 minus 0.4 times 1, totaling 1.2 minus 0.4, which equals 0.8. So theoretically, for every dollar you risk, you earn an average of 80 cents. That's an excellent result. By the way, I recommend risking no more than 1 to 2% of your deposit per trade. That way, even a streak of 5 losses in a row will take no more than 10% from your account, while a streak of 5 wins will give you a 10% gain. This grows your account steadily without wild drawdowns. Now, let's avoid the mistakes that ruin this strategy. First, never enter without filter confirmation. You see the Z-score spike, the pullback, and you think, whatever, QQ is just lagging, I'll enter on my own. This is the most common reason for losses. Don't do that. The filter specifically set up to weed out false moves. If there's no signal, there's no trade. The second mistake is changing your take profit on the fly. You're in a trade, the price is moving in your favor, and you think, let me move my take profit further, I'll make more profit. Stop right there. The system is designed for a 2 to 1 ratio. If you move your take profit, you break the statistics. Often, the price goes exactly to 2 to 1 and then reverses. Close your trade on time. The third mistake is moving your stop to break even too early. Traders fearing profit loss often move stops to break even too early. Consequently, a small pullback stops them out before the price hits their target without them. Trust your system. Keep your stop only at the original level. Or, if you really want to, only move it when the price reaches 1.5 times your risk, not before. The fourth mistake is trading during news events. In the first 10 to 15 minutes after important data is released, like news about the asset, the Fed's rate decision, CPI inflation, or the consumer price index, the market is chaotic. The Z-score can shoot outside the bands and come back several times a minute, and the QQ indicator repaints itself. Wait for things to calm down. Usually, 15 minutes is enough. It's even better to skip trading for an hour after the news. The fifth mistake is using time frames shorter than 15 minutes. On 1 to 5 minute charts, the noise is just too strong. The filter doesn't have time to work, and the win rate drops below 50%. If you're a scalper, check out other videos on the channel. There are separate systems for that. This strategy is for intraday and swing trading. So now you have everything. 2 indicators with precise settings, 3 rules you can memorize in a minute, an understanding of why this works, mean reversion and noise filtering, knowledge of common mistakes so you can avoid them, and most importantly, a clear system with no guesswork. What should you do next? Open a demo account and make 20 trades strictly by the rules. No deviations, no, I think it's better to enter earlier here. Just follow the rules. You'll be surprised at how easy trading becomes when you have a system and you trust it. And remember, the market rewards consistency, and now you are a systematic trader. You have the strategy, the settings, and the rules. All that's left is to follow. Thank you for watching, and I wish you successful trades. See you in the next video.